Hello, trader friends. Uncle Tony here. I want to thank all of you for watching my trading plan video. I it it's amazing how many people wrote me, and I want to thank you. And some of the comments, I mean, most of the comments were asking me to do separate videos for each of my favorite trading strategies. So that's what I'm going to do, and hopefully you guys enjoy it. And why not start with my favorite strategy? So my favorite strategy on planet Earth is the 120. And why is it my favorite strategy? Because it's easy to execute, it's easy to understand, it's a winner a lot of the time. Remember, this is not a financial advice. I'm not recommending anything. But last year, I only had one loser out of all the 120s I did. And the losing trade that I did, I rolled it to the next month and it became a winner. So I batted 1,000 in 2023 doing the 120. And for that reason, it's my favorite trade because my favorite thing is making money, baby. So that's what I'm going to show you today. And I'm going to show it to you in four flavors. What are the four flavors? You see, everybody's trading account it's a different size. So some people have a lot of money. Some people, they trade with a little bit of less money and they're just starting out their trading careers. And that's absolutely fine. So normally I place these trades on SPX, and then I'm going to go down one notch and we're going to do ES, which is 50% of SPX. Then we're going to go down to SPY. And lastly, we're going to go down to the mini ES called MES. And that is I would say, the smallest trade that you can do with the 120. Of course, if you have a super small account, maybe $1,000, $2,000, this trade, you can do it if you add a defined risk put at the way out of the money to define your risk. And so you see, everybody can do this trade. So very good. Let's get to it. Let's go to my beautiful Tasty Trade platform. And here we have it. And I'm going to start with SPX. Why am I going to start with SPX? Because that's the underlying I trade all the time. The first thing we're going to do is I like to go out 45 to 60 days out. So February is 40 days out and March is 68 days out. So I'm in a little bit of a pickle. And because I want to make this trade a little bit more conservative for you guys today, I'm going to choose the March expiration. And why is a further out expiration more conservative? Because there's more time, there's more premium, there's more extrinsic value, and that will make this trade a little bit more conservative. So the first thing I like to do is I choose my expiration. As you can see, I love the bright white expirations, which are the monthlies. Why? Again, because they have more liquidity. Of course, SPX is a super liquid product, and all the expirations are absolutely fine. But I always choose the monthly expiration because it also keeps me grounded, keeps my trading orderly, and I can make good decisions. Once we open the trading chain of Tasty Trade, there's something I really love. Do you guys see this brownish color? That is the expected move. It's unbelievable how they can just put it on the platform. So we can see that for March, SPX is expected to go from 44.95, and to the upside, it's expected to go to 4,900. Wow. I hope it does not go to 4,900 because that would be painful for some other trades that I have on. But that's a pretty wide range. And if we keep scrolling down, Tasty Trade will let us know where the one standard deviation place is at 4,400, and the two standard deviations, which are way out there, at 4,100. So as you can see, that's the playing field that we're going to be playing inside one standard deviation and inside the expected move. Now, the second rule that I have is we open the trading page. Then I like to go to delta. And then I'm going to look for the 25 delta. So here we have it. And I'm a person that likes round numbers. So it really doesn't matter if you choose the 45.55, the 45.60, the 45.45, 45.40. It's a ballpark. But because I like round numbers, I'm going to choose the 45.50 strike, and that we're gonna go long. we're going to go long. Let me clear something happened here. I'm going to go long the 45.50 strike, and you see it turned green. Green means that we're buying it. If we only buy this put, you can see it has a 21% probability of profit, which is a bad trade. It has negative extrinsic value of $4,600, which is a bad trade also. And it has a negative theta of 54 daily dollars. So just buying an out of the money put immediately, you can see that's not the play that we want to follow. Then what I like to do is I like to find a couple of puts, because it's called the 1-2-0, so we're going to buy one and sell two. I always like to collect around $16 to $20. So in order for us to collect $16 to $20, what I do is I grab my calculator and I add 46 plus 20 is 66. And then I divide that by 2 because we're buying 2 puts. And then I'm going to look for a put that's worth $33. And here I found it. It's the 45, 70, 65, etc. And because, again, I like round numbers, I'm going to choose the 44.75 put. And I'm going to sell 2 of these guys. One important thing to notice here is that I want to be at least here at the 44.95. Now my selected put is out. It's even further out, which I like because it's more protection for us. And also that it's generating a credit. So here, if we go look at the trade page, we're buying one March 15th long put for 40 at the 45.50 strike, and we're selling 2 puts at the 44.75 strike. And that comes out with for $23 credit. And guess what, boys and girls? That's, in my point of view, it's a little bit too much credit. So let's see if we can go. Let's see if we go to the 44.50, and that would make it a big round number for us. I'm going to start moving it. So I moved it to the 44.50, and then it's going to make it 100 points wide, which is absolutely beautiful. And we're still having $17 credit, which is amazing. Now, if you guys are like me, let's take a look at the Greeks. The probability of profit is now 92%. Wow. Yep. Bingo. Check. Second trade parameter that I like to look at is the extrinsic value. It's 1695. Positive. Check. Tony likes it. And a positive theta of $46. So every day I'm going to make $46 by holding this trade. So I really like that. And here is the only sad part of this trade. The maximum profit for this trade is $11,000. That if we are really lucky and SPX ends up at 44.50 in March, which you guys forget about it. It's very difficult, and we're not playing for $11,000. And the maximum loss is showing $433,000, and we will incur that maximum loss only if the S&P goes to 0. Now, if the S&P goes to 0, that means probably the end of the world just happened, and this 1-0 trade is going to be the least of your worries. So don't worry about the 0%. And here the computer is telling us that it's going to take $70,000 of collateral to place this trade. I know what you're going to say. $70,000 is a lot of money. It is. It's huge amount of money. That's why I'm going to do it in SPX. I'm going to do it in SPY. I'm going to do it in ES and MES. Now, because I'm a graphical person, I would love to take a look at this trade and analyze it. And here we can see that we have our beautiful 1-2-0 trade. I punched it up. Here we are. We can see we're long 145.50, and we're paying $47.40 for it. And we're short 244.50 puts, also in the March expiration, and we're collecting $31.30 for those 2 puts, giving us a net credit of $17. And look how beautiful this trade is. If the S&P stays here, we collect $1,700. If the SPX moves down to 45.50, we collect $1,700. If the S&P ends up in this little circus tent that I call it, then we're going to start hitting those big numbers. And if the market starts going down horribly, our break even is at 43.38, which is 300 points out. And 300 points, I'm going to grab my calculator so I don't want to make a mistake in the video. And that's 6.5% down. So the S&P can go down 6.5%, and we're still going to be okay in this trade, which is another reason why I love this trade. So that is the setup. But how does Uncle Tony play this trade? So here is a concept that's going to be very difficult for you guys to understand if you don't do this trade often, if you have never done it, because the chart is not showing you what I'm going to tell you right now. It's a secret. So if the S&P starts moving down little by little, not hard. If it moves hard, then we won't be able to get our big profit. So if the S&P starts going down, and time passes on, so this $17 credit might turn out to give us a $5 credit if we close it. Credit. Yes, boys and girls. Have you ever had a trade where you open it for a credit and close it for a credit? I know it sounds like magic, but I did it every single time except one in 2023. And why you start to think, hey, Tony, the line is straight. I don't see any place here where you can make more than $1,700. And what you guys are not seeing is this little brown line that goes down. That's the zero expiration line. That means what will happen to the trade if the market goes down right now. So if the market crashes down after I place this trade and it goes to our maximum profit, we will actually be losing money on this trade, because the curve is pointing down and the stock market moved down too fast. So this trade likes slow down moves and with the lot passage of time. So we need a lot of days to pass, and then we can achieve what we want. So my goal, of course, if the stock market flies up like crazy, and we're going to be able to close this trade and collect our $1,700. Now, if we're lucky and the S&P stays between 4,700 and 4,550, and time passes by, you are going to freak out. Are you going to be surprised how you can take another 10 or 15 points, which is another $1,000 to $1,500, and wow. And that's my goal for this trade. When I place a 120 in SPX, that's another Uncle Tony rule. I want to collect between $2,000 and $3,000, and $3,000 is a little greedy, and some people are greedier than Uncle Tony, believe it or not, and they want to collect sometimes $4,000 or $5,000 out of the 11 possible $1,000, and to me that's too much risk. So just be content. If the trade works out, collect your $1,700, and if it works in our favor, like I said, a slow down move, then we're going to be able to get this brown line to lift up like a helium balloon, and then this trade we can close it for a credit and be super duper happy. Now, everybody's worried how much money they're going to make. Uncle Tony is worried how much money can we lose. Why? Because professional traders, not that I'm a professional trader, but I think I am, professional traders are more concerned with losses than with profits. And let's go back to our beautiful Tasty Trade platform. So what happens if the S hits the fan? You know what I want to say, but the YouTube algorithm doesn't like me to say the word SHIT. So if the SHIT hits the fan, what's going to happen? So this trade is built by actually two positions. So this trade has a long put vertical, which is a 1 long 45.50, and short 1 44.50, and then it has a naked component, which is a second 44.50 put. But if the S&P goes down really hard, this long put vertical is going to go to $100 or 90 some dollars. And what does Uncle Tony do if that happens? If this trade goes down hard, goes down very hard down, what I like to do is take out one long put and take out one short put, collect maybe out of the $100. I like to collect between 90 and 93% of the width of the strikes. So that means I'm going to be collecting between $100 and $93. And then I put those $9,300 in my pocket. It's in my pocket. Just remember when you're in Vegas playing blackjack and you have a nice hand, you grab some of those chips, you put them in your pocket, and that's profit that no one can take away from you. And the other thing that I like to do is if the short put, the naked put, the 4450 put is challenged, what I like to do is to, what I call it, roll it down and out. What does that sounds very fancy? Down and out. What is down and out? Down and out means closing the 4450 put for a loss, and then maybe going to April and finding a put that is the same value as our closed trade, and selling it again, and generating a credit. And let me show you, because for me and for a lot of you advanced traders, you know what I'm talking about, but I'm going to try to make this easy for the rest of us. So let's say we have this put, right? It's worth $33. So let's pretend as the S&P went down to 4450. That's where I like to roll it out. So what I would do is I would buy this put for 31.80. Then I would go to the month of April to keep the dream alive, and I'm going to look for a put that has more than $32 credit. Because remember one of Tony's rules, death before debit. So I need to get a credit. So here I'm going to find, there we go. I like round numbers, like I said. I can sell the 4,300 put for a credit. And remember, boys and girls, we put on this trade for a credit. It went against us. I sold the long put vertical for a credit. And now I'm rolling my put down and out to give me a little more cushion and for a credit again. So I'm not paying for anything. Credit, 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 triple credit. And if you see here on my trading platform, you can see that I moved the put down $150. Can you believe it? It was down $200 from the at the money when we put the trade on, and now I was able to add another $150, which is another 4% almost protection to our trade. And that is how you stay alive. If we go to the Analyze tab now, you see my break even of the new put is $4,300, and then we can hold a little bit more. Now, what happens if it keeps crashing? Well, if it keeps crashing to 4,300, what we're going to do is we're going to roll it down and out again. Shut the $4,300 put down and maybe sell a 4,000 put further down for a credit. So that's how you play the trade if it starts going wrong. And to summarize the SPX, we buy the 25 delta. We look for two puts down there that are past the expected move. In this case, past the 44.95. We try to collect between $15 and $20, and then hopefully we get a small move down so we can close the trade for another credit. If the market runs up like crazy, nothing happens. We're going to collect our $1,700. And if it crashes down, you're going to take profits on the long put vertical and you're going to roll the put down and out. Hey, was it too fast? Was it too much? Let me tell you something great about YouTube. You can hit pause. You can hit 75 speed. I know a lot of you guys watch my videos at 1.25, 1.5x, maybe 2.5x, because sometimes I talk too slow. And you can adjust the video to your speed, and you can pause it. you can open your Tasty Trade platform and set up the trade. So that's the SPX. Now, as promised, Uncle Tony promises, Uncle Tony delivers. Now I'm going to place this trade again on SPY, on ES, and on MES. So get ready. Okay, boys and girls, as promised, the second size down from our McDonald's extra large triple meal is ES. ES is half of SPX, and ES is 5 times SPY. So it's right in the middle for people that have medium-sized accounts. If you have a medium account, then you can use ES if SPX is too much. And here, once again, let's try to go to the March expiration. And unfortunately, we don't have as many strikes on ES as we do on SPX. And here, the deltas are a little bit different. And why are they different? Because SPX futures, the E-minis, have embedded the dividend and the time cost of money. So always carrying futures positions is very similar, almost the same as the index, but not identical. So in order to replicate this trade, what I'm going to do is I'm going to buy the 45.50 once. Remember, we sold the 44.50 twice. And hey, like magic, again, we're getting that $17 credit. That our checklist are the short puts away from the expected move? Yes. Now, are we getting a $15 to $20 credit? Yes. And let me show you the magic. The magic here is the profit. The maximum profit is going to be half. Remember, on SPX, it was $11,000. Here is around $6,000 or $5,800. So the profit is half, but the money that Mr. Tasty Trade wants us to use as collateral for this trade is only $11,000. 11,000, boys and girls. So we went down from 17,000 to 11,000. So if you have a mathematical mind like I do, I says, am I going to risk $70,000 for a $1,700 credit, or should I risk $11,000 of buying power for $6,000 credit? Just for that reason, ES looks much better as a capital usage. Now, if we look at the trade in the trade analysis, we can see the trade is it's exactly the same. Now the computer moved it on me. It didn't like me, but there you go. It looks exactly the same, but remember, it's half the size, but with a lot less capital usage. Now, let's go down another notch to SPY. Remember, SPX is the big boy. ES is half of SPY. I mean, half of SPX. ES is half of SPX, and SPY is 1/10 of SPX or 1/5 of ES. So let's go to the SPY. Let's go to the table, and let's go to the March expiration. And if you remember the trade, we bought one 45.50, which is the 455, because we're going to take 1 0 out. It's 1/10. And then we went to the 44.50, which is this one. And we're going to sell two of these guys for $1.80. Once again, it's not magic. $17 credit. This is $18 credit. Now, here is something weird again. You see, our maximum profit is $1,100, and the capital required is $7,000. And you're thinking, hey, this trade in SPY is not as capital efficient as ES. And let me tell you why. Because ES futures have something called span margining, and futures require much less capital. But every time the computer asks you for less capital, just think of yourself. The risk is the same, right? It's all the size. If you start trading futures be more conservative. Why more conservative? Because the computer requires less capital and you think you have more money in your account than you really have. So if you want to stay conservative, trade SPX and SPY. If if you feel comfortable with the trade and you want to have more capital efficiency, then move up to ES and do the trade on ES. And I think ES is beautiful. ES has another benefit. Yeah, futures trade 24 hours a day. SPY and SPX are only open from you know from normal market hours, and SPX trades 15 minutes after 3 o'clock Central Time, after 4 o'clock Pacific, 4 o'clock Eastern. So SPX gives you 15 more minutes to close the trade. And lastly, let's try mini ES slash MES. The MES it's also the same thing. It's an S&P 500 product, SPX, ES, SPY, MES. Let's go to the March expiration. Let's go to the 4550. We're going to buy one of these guys. We're going to go to the 4450. Sell two of these guys. Once again, it's not magic, boys and girls. $17 credit. And here the size is more reasonable. Here the maximum profit is $585. And the capital required is only $720. Not bad, right? Not bad at all. And if $720 is still too much for you guys, I'm gonna give you an extra tip, little Uncle Tony tip. So we have $17 to play with. If you have a smaller account, why don't we use some of that $17 to define our risk? And I like to buy something that's worth around $7 because I don't like to waste money. So what if we buy, let's say, the 4,000 put? Our trade now, we sacrificed $7 out of the $17 credit. But look at the beauty now. Now the credit, the maximum profit is 548 and the buying power is 580. So it's like 100% return on capital. Let's take a look at the chart with the let's take a look at here. We have it. And let me make it a little bit, boom, a little bit more. My God, the other put is so far down that it wants me to move it down. So you see the trade is practically the same trade. And with the bottom, with buying the 4,000 put to define our risk, now this trade, of course, we cannot call it the 120. Now this trade becomes a broken wing butterfly. I know it sounds fancy. The reason why it's a broken wing, because the distance between the first part of the butterfly, which is this part, 4550 to 4450, it's $100. And then from 4450 to 4,000, it's $450. And that's the broken hand, the broken wing. But the cool part about the broken wing butterfly is that you can define your risk. And then you see here at 4,000, the P&L stops going down and you define your risk. And if you have a smaller account, doing a broken wing butterfly instead of a 120 is perfectly fine. In fact, here we can see the put. In fact, sometimes when Uncle Tony goes crazy and he has too many 120s on at the same time, Uncle Tony also has limited capital. Nobody has unlimited capital. Well, maybe except for my friend Tom or my friend Bat. But normal earthlings like you and me, we're restricted by our capital. And by buying this extra put down here, we define our risk, we use less capital, and it allows us to place more trades in our accounts. So there you have it, trader friends. The 120, Tony's bread and butter trade. And I don't know if you noticed, I only showed this trade on the put side. Why? I do it on the call side too, but I don't even want to have a recording of Uncle Tony showing you a 120 with a naked call on top. Because why? Naked calls cause pain. and I don't want pain on you. Uncle Tony loves pain. I'm the king of pain. Remember that song, King of Pain? But last year, actually, I traded the 120 on the call side really, really, really well. And but that's a little bit more advanced. Then you're willing to have unlimited upside risk. And if you have a move like we had from November to January, where just straight up, you guys are going to be in pain. And calls cannot be rolled out, down, up and out like you can with puts. Calls are much more difficult to deal with. Calls are more painful. Calls are a pain in the butt. So that's why I only showed this trade on the put side. And there you have it, the beautiful, the gorgeous 120. And I want to add something else. I'm going to give you a little tidbit why I like the 120 more than I like a regular naked put, because a naked put is one of the best trades you can have. So let's go back to our Tasty Trade platform. Let's imagine we have a tsunami. The tsunami is a market crash coming down. This tsunami wants to give us pain. Pain because we have a naked put here, and the tsunami wants to eat our naked put. But what is the tsunami going to encounter before we hit the pain point? The tsunami is going to hit a little wall, a green wall, a long put. So the reason why I like the 120 instead of the naked put is because the first thing the tsunami hits when it's coming down is a long put. And what happens to a long put when it encounters the tsunami? It explodes, but it explodes up in value. It gives us a lot of money. It puts a lot of money in our pockets, and it protects the trade a little bit more. And then, of course, if the tsunami keeps coming, it sucks our trade and it kills it. So at least we have a little bit, a little wall, a little protection extra than doing the naked put by itself. Naked put by itself is one of the best trades on planet Earth. I mean, I do it all the time. I do my put campaign. All my strategies, the 120, the 111, the 221, the 331, the 441, the broken wing butterfly, everything has a naked put component in it. But that long little wall, trust me, it can save your butts if you start trading. Remember, if you want to grow your pile, follow Uncle Tony. And if you want to keep making money, you have to risk it to get the biscuit, baby.